If you're in your late 30s, 40s, or early 50s and earning the most you ever earned, but still feel like your monthly obligations keep expanding, this is about fixed expenses during peak earning years and why they tend to grow faster than expected for many American professionals. For many working professionals in the United States, the 15 to 20 years between roughly ages 35 and 55 represent peak earning years. Salaries are higher than they were in the 20s. Promotions have accumulated. Household income may be supported by two careers. Yet during this period, a common pattern appears. Fixed expenses begin to rise and often stay elevated. Not discretionary spending, not vacations or lifestyle upgrades, but fixed, recurring costs that are difficult to adjust once established. Mortgage payments, property taxes, health insurance premiums, child related expenses, auto insurance, long term debt payments, retirement contribution commitments. What makes this period financially complex is not low income, it is the growth of structured obligations. Housing is usually the first major shift. Many professionals upgrade homes during their 30s or early 40s. This often aligns with family growth, school district considerations, or proximity to work. The purchase may feel reasonable relative to income at the time, but over the next several years, property taxes increase. Insurance premiums adjust upward. Maintenance becomes less predictable as the home ages. The mortgage payment itself may remain fixed in a traditional loan, but escrow components do not. In many counties across the US, property tax assessments have climbed steadily over the past decade. Home insurance costs have risen sharply in several states due to weather risk and rebuilding costs. What was once a manageable monthly housing cost can quietly expand by hundreds of dollars per month over time. Unlike discretionary spending, housing obligations are not easily reversible. At the same time, retirement contributions typically increase during these peak earning years. Financial planning guidance often suggests contributing 15% to 20% of income toward retirement during one's 40s and early 50s. For higher earners, this can mean significant payroll deductions into 401k plans. Catch-up contributions begin at age 50, increasing the annual contribution limit. On paper, this is a positive development, but from a monthly cash flow perspective, it adds pressure. Higher income triggers higher expectations for savings, and those savings reduce take-home pay. Healthcare costs often rise during the same period. Employer-sponsored insurance premiums have steadily increased in the US, and employees are bearing a larger share of the cost than in previous decades. Family coverage in particular can represent a substantial monthly payroll deduction. Beyond premiums, high deductibles have become more common. Out-of-pocket exposure has expanded. Even routine medical expenses can add to fixed financial commitments when managed through health savings accounts or structured payment plans. For professionals with children, education-related costs tend to peak during these same years. Childcare in earlier years transitions into extracurricular activities, technology needs, tutoring, transportation, and eventually college savings contributions. While each expense may appear incremental, collectively they shift the household's fixed cost base upward. If children attend college during a parent's peak earning years, tuition exposure overlaps directly with retirement contribution pressure. There is also career-related cost expansion. Higher level roles may require longer commutes, relocation to higher cost areas, or professional expenses that are not fully reimbursed. Networking, certifications, industry memberships, these become embedded in maintaining career position. Inflation compounds all of these effects. While inflation rates fluctuate year to year, cumulative price increases over a decade meaningfully reshape household budgets. Utilities, insurance, groceries, services, Even modest annual increases accumulate. When fixed contracts renew annually, higher baseline costs lock in. Another factor is debt layering. In early adulthood, debt may primarily consist of student loans. By mid career, households often carry multiple structured debts: mortgage, auto loans, potential home equity lines, educational loans for children, or lingering student debt. Even if individual balances feel manageable relative to income, the combined fixed payment structure can become rigid. What distinguishes fixed expenses from variable spending is their psychological and structural weight. Fixed expenses require payment regardless of monthly performance. They cannot easily be scaled down during slower income periods, career transitions, or economic downturns. They create a floor, a minimum monthly outflow that defines financial stability. During peak earning years, that floor often rises. There is also a behavioral component. As income rises, households tend to normalize higher fixed commitments. A larger home feels justified. A newer vehicle becomes practical. Higher insurance coverage feels prudent. Retirement contributions expand to match professional identity. Each decision, individually rational, adds to the recurring obligation base. This does not imply financial mismanagement. It reflects the structure of American middle and upper middle class life during mid career. Income growth during peak years is often slower than earlier in one's career. Large percentage raises are more common in the 20s and early 30s. By the 40s, raises may become incremental. Promotions are less frequent. Career plateaus are common in many industries. At the same time, fixed expenses grow steadily. This mismatch, slower income acceleration alongside rising structured obligations, creates the tension many professionals describe. They are earning more than ever, but flexibility feels reduced. Liquidity tightens not because of discretionary spending, but because the baseline monthly requirement is higher than at any previous point. Another dynamic is risk concentration. During peak earning years, professionals often carry the highest financial responsibility of their lives. Dependents rely on income. Retirement timelines become visible. Major assets are at stake. Insurance coverage must be maintained. Creditworthiness matters. Financial decisions become less reversible. A housing upgrade made in one's 20s may carry lower long-term consequence. A similar upgrade in one's 40s carries deeper implications due to scale and obligation layering. This period also overlaps with aging parents for many households. Support for older family members, whether direct financial assistance or indirect costs, can further increase fixed commitments. When examining household budgets across income brackets in the US, a consistent pattern emerges. Fixed expense ratios often increase in mid-career, even when gross income peaks. This is not necessarily a crisis pattern. It is structural. Peak earning years coincide with peak responsibility years. What makes this dynamic difficult is that it often unfolds gradually. There is no single event that signals the shift. Instead, renewals, upgrades, contribution increases, and inflation accumulate. The result is a higher financial baseline. From a distance, income charts may show progress. Net worth may increase through home equity and retirement accounts, but monthly cash flow can feel tighter than expected. Understanding this pattern clarifies why many professionals describe mid-career finances as stable but constrained. Stability comes from income maturity and asset growth. Constraint comes from elevated fixed obligations. Over time, the trajectory changes again. Mortgages eventually amortize. Children age out of dependent years. Retirement contributions shift from accumulation to withdrawal. Certain insurance costs decline. Fixed expense pressure often decreases in later stages of life. But during the peak earning window, the expansion phase is common. The experience is not necessarily a sign of financial misalignment. It is often a reflection of how American household economics are structured during mid career. Higher income enables larger commitments. Larger commitments increase the baseline, and that baseline defines financial flexibility. For professionals navigating this stage, the key insight is awareness of the structural nature of the pattern. Peak income does not automatically mean peak flexibility. In many cases, it marks the period when fixed expense growth is most visible. And recognizing that dynamic provides clarity about why financial pressure can feel elevated, even at the height of earnings.